Vanguard is one of the most trusted names in the investment management industry. So when I saw their latest market forecast and what they're predicting going forward for the next 10 years for the US stock market, I had to share it with you because it shows something dramatically different than what we've seen for the last 10 years. So let's jump in and take a look at it. The report is called Vanguard's Capital Markets Model Forecast. It came out in December of 2024. And I'll give you a hint. The subtitle gives away a little bit of what we're about to see. The subtitle is Setting Realistic Expectations. So let's jump in and see what they have to say. This is from their forecast of asset class performance as of November 8th, 2024. It's an interactive view. You can Google it and find it for yourself. But let's start off. Let's start with U.S. equity. So over the last 2 years, from the October 2022 lows until the highs in 2024, the stock market was up 60%, the S&P 500, in just that 2-year period. So unfortunately, they're not expecting anything like this. You can see that chart. It goes from a little over 2% to maybe high fours, maybe 5%. And those are gross returns. So if there's any fees that come out of that, that would come out. So how long would it take to get a 60% return in U.S. equities at 2.2, 2.3% to 5%? I can tell you this, a heck of a lot longer than it did before. So, even let's call it 4.5%. That's probably 10 to 12 years until you get that same 60% return. Now, just because this is a forecast, it doesn't mean it's going to come out to be true, right? There's a lot of things happening in the U.S. economy right now. Particularly right now, there's all kinds of changes taking place. Much of it is going to be very stimulative for businesses. We've got what's going on in politics, but we also have what's going on in artificial intelligence. And I think there's going to be a lot of efficiencies gained for a lot of companies. We might still be 2 or 3 years away from that, but I don't think we are. I don't know. But some of these AI models, and think about all the routine stuff that we all do at work, a lot of that's going to be handled for us by AI, probably sooner rather than later. And then even some of the more sophisticated stuff. But let's keep going on this report. So the bad news here is what they're predicting for U.S. equities. And stick around to the end because I'm going to share with you my views as an investment advisor for over 20 years. Looking at this, what I think we all should be thinking about when it comes to our own portfolios. Okay, global equities, they have, looks like a 6.5% to 8.5%. That's ex-United States, and that's unhedged. And then global ex-US developed equity markets. So this is just the developed markets doing a little bit better than that. Looks like about 6.5 to maybe 9%. The emerging markets are going to do worse, which, according to Vanguard, their prediction is it's going to do worse, closer to 5 to 6.5%. And emerging markets have a lot of risks that developed markets do not. So I'm surprised to see that. But I think what that's pointing out is maybe what I was just saying earlier. All of these advances of AI, all these technology advances, it's easier for developed countries to deploy them and get those efficiencies sooner. Eventually, it'll also be available in the emerging markets as well. Okay, look at this for U.S. value. U.S. value is predicted to do quite a bit better. And for me, 1 percentage point is quite a bit better than the U.S. markets, the U.S. equity markets in its entirety. But look at this, U.S. growth. That is straddling 0% growth over the next 10 years. This is a 10-year annualized return forecast. So Vanguard could see a world where U.S. growth stocks grow 0 to 2%, essentially flat, right? When you take into account inflation. That is staggering. And think about, like, even the S&P 500 is about 40% of it is exposed to technology companies, and a lot of those companies are US growth companies. US large cap, this is the traditional S&P 500. I would assume that that's what they mean by that, is at about 2 to just a tad over 4%. Um, US, small cap is doing better at looks like about 4 to a little better than 6%. And then US REITs, REIT stands for Real Estate Investment Trust. So think about, publicly real estate that you can invest in through a public channel. In many of these, you can invest in over the New York Stock Exchange or the NASDAQ, normal exchanges, but investors will own office buildings or they'll own malls or their own senior housing, and they'll put that together in a package that people can invest in publicly. So the real estate that's been doing so well lately, at least in the residential side of things, they see that coming in at below 4% to about 6%. So what does all this mean for us? As a financial advisor, one of the most common questions I would get asked is, "Hey, Azul, why don't I just put this in the S&P 500? Why do I bother with diversifying?" And it's a good question because the S&P 500 has done so well. Um, for the last decade, the last 15 years, it's had a great 20-year run. But it's not always that way. Eh, I call it a quilt. If you look at these different asset classes, and sometimes one asset class is better than the other, and they kinda move around. So as we get older, as we increase our net worth, it's important to look at diversification because we want what would happen. Like I said, the S&P 500 was up 60% in a 24-month period. What would happen if that dropped 60%? And that was your entire stock allocation. And what happens if that stays down for several years? That could really derail years and years of hard work. It could cause you to panic and sell at the wrong time. And that could, I've seen it where people that were just a couple years from retirement, all of a sudden something like that happens and they really panic. And unfortunately, they lock that in. And then instead of being able to retire in 2, 3, maybe they would have had to work 2 more years, 5, 2 more years or 4 more years. But once you lock in those losses, you might have to work an extra 5, 7, 10 years. And I'm just using numbers here, but you can see where that would happen. So why don't you do the S&P 500? Because there's no guarantee that the future is going to be like the past. And the tech darlings, the super scalers they're called now, those companies have done so well. And I'm not saying that anything bad's going to happen to these companies. I'm not saying that the S&P is not going to continue to do really well, and people are going to be glad that they have some of their portfolio in. But as our nest egg grows, job number one becomes protecting that nest egg and getting reasonable growth and not taking any risks that could side rail all of the hard work that we've done. And as much as I've talked about the quantitative side of things, how the stock market's doing, there's also the qualitative side, right? The heart and what you want to do and what's going to give you the most joy in your life. And that's why I made this video here. Why waiting to 65 to retire might be a big mistake. I'll see you in that video. Bye-bye.